we talked about remeasurement. Let's talk a little bit about translation. What the heck do you do with translation? So we've got something that's in the functional currency, a subsidiary in its functional currency, but that functional currency is different than the reporting currency. So what we want to do is we want to take that financial statement, that set of financial statements in the functional currency and change it to the reporting currency. So that way we can consolidate both entities, if you will. It could be more, but we can consolidate both of those entities using the reporting currency. Well, there are going to be gains and losses associated with that difference between the functional currency and the reporting currency. So we're going to go through and do virtually the same thing that we did with remeasurement, but any gains or losses that come out of the translation process, those do not go through the income statement. Those go through OCI. Those go through an adjustment to equity. So let's take a look and just make sure we understand what the literature is. So let's go to 830, and we're going to look at translation of financial statements. All right? And we're really just going to go right to other presentation matters. I think that's really where we need to spend our time. Right? And this is what we look at, right? We're looking at translation using the current exchange rate, right? We use the current exchange rate, and we use the current exchange rate for all assets and liabilities. The exchange rate of the balance sheet shall be used. And for revenues, expenses, gains, or losses, the exchange rate should be based on when those elements were recognized. So if I did a sale back in January and I'm looking at a December 31 translation, I shouldn't be using the December 31 rate. I should be using the January rate. Now, that may not be practical. Right? So in this case, we're never using the historical rates, right? We're only using the current rates. Right? Only using the current rates. So what about these revenues and expenses? Is there anything that I could potentially do to get rid of this whole idea of I got to go keep track of all of these rates throughout the entire time? Well, the answer is that you can use average rates, right? You can actually use average rates to do this. So let's take a look at, and they give you right down here in 45.5, the implementation guidance in 55.10 through 55.11 talk about the use of averages and other methods of approximation if you're not keeping track of all of the exchange rates when you executed those transactions. So let's just take a look at those two paragraphs. So the issue comes down to whether or not it is practical to be able to keep track of each and every exchange rate that happened during the year for every single transaction, right? And because there's a degree of detail and record keeping and computations that could be burdensome as well as unnecessary to produce reasonable approximations of the results, other methods are appropriate, right? Because, as it says here, exchange rates at the dates for that over numerous revenues expenses are recognized is going to be generally impractical. So they can use an average, but what happens if you have seasonality? If you have seasonality, then you may have to put more weight, say revenues, you may have to put more weight on the exchange rates where revenues were the highest during the year and lower weight on the exchange rates where revenues were lower during the year, so that you're giving a weighted average for those exchange rates. Is it going to be perfect? Is it going to be exactly right? No. Do we care? No. But it has to be materially appropriate. We can't be using exchange rates that would provide a material misstatement in this foreign currency translation. So when we do this translation, everything goes through other comprehensive income, right? Everything goes through other comprehensive income, and we use the current exchange rates for doing the translation of foreign currency statements.